All right, ladies and gentlemen, we have with us our session chair, Anupam Mittal, the founder and CEO of People's Group, Shadi.com. Last year also you were here. We had a very energetic session. Yeah, that was so fun. Superb. Okay, and joining us is our other two speakers, Kunal Bahl, the co-founder and CEO of Snapdeal, along with Rohit Bansal, the co-founder of Snapdeal. And this is Reinventing a Unicorn.
Welcome, Kunal, Rohit, my good friends and fellow entrepreneurs who I admire deeply. Thank you for coming to Bombay for this. I think we all appreciate it very much. You don't need much of an introduction. You're both iconic entrepreneurs. You've put India on the startup map in many ways. You've created perhaps one of India's first unicorn, and you guys have been now together for, I think, over 12 years you've been working together. But during this time, you've also had 3 near-death experiences, and you've almost been extinct 3 times. So, क्या बात क्या है? मतलब, you don't like the straight and narrow path? You like adventure sports? You like living on the edge?
Yeah, firstly, thanks so much for having us, and it's always great to see you. And thank you to TiEcon for inviting us. I think there is probably an element of us wanting to live on the edge, but the pain we have gone through multiple points in our journey, I won't wish it upon anyone, but you also get your greatest powers from the greatest wounds. But it's obviously been a phenomenal journey, and we can't complain.
No, I think that's the true test of entrepreneurship is perseverance. And I don't know if you feel that, Rohit, but maybe you can tell us in a nutshell, the last 12 years, what's been sort of the highs and the lows in this journey that has brought you here today?
First of all, thank you for having me. It's been a fantastic journey over the last 12 years. I think we have had our fair share of ups and downs as a business. We started off as a coupon booklet business back in time when there was very limited internet, pivoted to an internet company, which in itself was a big change for the company. First few years, we ran the company with our own money, and we used to very often run out of money because we just were making payroll to payroll. And then I think, even though it seems from the outside that it's been a near-death experience many times, which it has been, I think through all these twists and turns, I think we were trying to discover in some shape and form a good product market fit for ourselves. Probably took much longer than what most companies do, but I think eventually we have it. And it's been a fantastic learning experience for us. Obviously, it's much more fun when it's an easier story to tell in hindsight as compared to when you're going through the grind yourself.
Yeah, so would you say product market fit is therefore a moving target and it's never quite something you achieve?
I think the one thing we finally realized that for an internet company, the definition of product market fit has to include the right unit economics. I think that was the missing link for all these years, that we were thinking we reached product market fit, but then we realized that a business needs to have the ability to make money or generate economics to have true product market fit.
So what you're calling product market fit is actually a euphemism for wisdom.
I think in our industry, that's very required.
Good. No, but 12 years you said through twists and turns, and I think one of the big things that's been consistent in these 12 years, so while your business model and products have changed, is you two being together, right? So you started out together, you're still sitting here together after 12 years. I'm an investor myself, as you know, and your experience too suggests that many a times one of the biggest reasons that companies fall apart is teams not being able to stick together or co-founders not seeing eye to eye. So what keeps you guys together? You don't have a choice?
You go first.
I have to think long and hard about the nice things I have to say about Rohit now. No, I can't imagine a day of this story over the last 12 plus year without having Rohit by my side. Like, I don't think I would have made it past a single day if I didn't have Rohit by my side. And I think
What does your wife have to say about that?
well, for a good part of those 12 years, she wasn't around. So, Rohit gets first preference.
Actually, the fun part, which you probably didn't mention, is that we've been friends for 11 years before that as well. So I think now we've known each other for, 20 plus years. And I think, at the core of everything, what has really kept us together is, outside of all the fun and jokes, we have an incredible amount of trust and respect for each other. I think we trust each other's judgment quite a bit. And I think there's an inherent respect for each other's judgment as well. I think that's something that has never gotten breached in all these years, both as friends as well as co-founders. Actually, I got married after we started the business. I feel actually the learnings of this relationship gave me a happier marriage also. Because I learned how to build a great relationship. So that's why I have a happy marriage too.
Oh, wow. So who wears the pants in this relationship? You can ignore that question, sorry.
Yeah. No, but I think actually when things are going great, it's very easy to say, oh, we have a great relationship and we get along so nicely and everything's hunky-dory. Relationships between co-founders, as in your personal lives, it's truly tested when you're going through stress. When it's a moment when the whole world seems to have stacked all the chips against you. That's the moment when even a tiny fissure in the relationship will just completely yank open and be the true test of how deep is, as what Rohit said, the trust and the relationship and the mutual respect that exists between the two people or multiple people. I think in our case, we've seen so many such tests along the way that at each one of those times, it's very easy to unleash your frustration, unleash your anger, unleash your disappointment upon the other person and start pointing fingers, etc. But we've never done that. At a moment when, people often ask us, how do you deal with disagreement? Like, do you guys fight? Well, we don't pull each other's hair and tear each other's clothes, but we have from time to time, distinctions in viewpoints on a particular topic. But the way we deal with it is very different probably from how other people deal with it. Like if about a particular topic, Rohit and I have a different viewpoint, we're not going to go discuss it in front of everyone, right? We'll go into a room in the office.
There's a boxing ring in that room?
No.
Transparent glass.
Transparent glass, right? And but we will we'll just talk it out, right? We'll hear each other's view. And at the end of that discussion, whether it takes 1 day, 2 days, 10 days, we will come up with one point of view. And it doesn't matter whose point of view that was. Now it is our point of view. And now we will back into it. We will back that point of view. And nobody can say, but this was Rohit's point of view. This was Kunal's point of view. This is now our point of view.
This is very insightful, actually. I want to deliberate on this for a couple of more minutes, particularly because we have a lot of entrepreneurs here. Yes, and I think this is an issue that many of you don't even know that you will deal with. Some of you are probably already dealing with. And perhaps one of the biggest issues, as I mentioned earlier, that causes value destruction. So tell me, is it in your case, and it could be different for different people, but in your case, were you just lucky enough to hit upon the right chemistry in terms of personality traits? Or do you think there's value in explicitly charting out how you will address disagreements and having explicit strategies for the same?
I would say it's more the latter. And I think there's always, like, entrepreneurs by definition have very strong opinions. Both of us are extremely, extremely opinionated, like I think most entrepreneurs are, because you have to have a strong point of view to be doing something which is very different from...
Loosely held strong opinions, if you will.
But I think, having disagreements or differing point of views, what that does is we see the two of us as a unit. And as a result, whenever I have something going on in my mind, I would bounce it off Kunal. And, sometimes you can go nuts as an entrepreneur in your thought process as well. And just having this dialogue, while it can seem tempering for you as an entrepreneur, that not all of my opinions will go forward, but actually that's what, a partnership like this adds value to that dialogue. Because by just bouncing thoughts off each other, the cumulative outcome we've seen over a period of time has ended up being much better than what our individual point of views were. So I don't think we started off with that mindset when we started. We probably started because we were great friends. We thought we should be doing business together. But over a period of time, as we've really gone through the ups and downs, sorted our disagreements, and made, over a period of time, made many judgments which worked out right, the trust in being able to openly discuss any disagreements, topics, etc. has grown. So now actually, contrary to earlier when we used to have different points of views and we used to think that, hey, we are going to have a debate, we actually look forward to bouncing thoughts off each other so that our own thought process gets richer as a result.
But that takes a lot of maturity. I think you're being very humble when you say, it is simply the fact that the other person has a lot to offer, but you need to be fairly mature and be able to park your ego on the side to, go to somebody else and respect their opinion in that given moment.
I think ठोकरे खा के सब में humility आ जाती है.
Well said.
I think that's what we've also seen, that we are not married to opinions. We all, at the end of the day, not just the two of us, our entire organization wants the right outcome. It doesn't matter whose opinion created the outcome. What matters is, did you get the outcome that you wanted or not? And the moment you zone out of wanting to be right every time, it liberates you. It liberates you to want to hear the other person out, want to be proven wrong also. Because
I
you
think
don't...
that's a very, very deep insight. The moment you liberate yourself from wanting to be right, and I call it a deep insight because all of us know this intellectually since we are very young. We can talk ad nauseum about, you shouldn't stick to your opinions, but to actually imbibe it is a big journey. And as you rightly said, right, that happens only after you've had a few stumbling blocks and you've taken the hits in the ring, is when you can see that.
I think one of the skills that most entrepreneurs can do well with is the ability and willingness to listen to differing opinions and actually use that to evolve their own viewpoint about things.
But by the very definition of entrepreneurs, they are the guys imposing their opinions on other people. How do you make that transformation?
That's why you need one person at least whose opinion you will listen to.
There you go, that's right. But good chemistry between two co-founders and a great understanding leads to respect, leads to affection, but it also leads to a friendship that may create somewhat of a wall for other people, right? Do you experience that, or do you worry that your bonhomie will actually exclude other people within the organization?
I'm sure that's a potential minor negative fallout of that. But the positives of the bonhomie, the alignment, the mutual trust and respect, as Rohit said, is so, like the positiveness around, the positivity around that is so high that even if there is some negativity around people seeing us as one unit always, I think it's okay. But we are also quite self-conscious about that. And we don't let our bonhomie or our united front come in the way of us listening to non-conforming opinions of our colleagues. We are quite okay with that also. Oftentimes, we are even open to the view that our collective opinion is wrong. And many times that has been the case.
And I think that's also changed over the years as we've matured as people as well. I think what you're mentioning probably used to happen a lot more a few years back. But I think now we've also learned how to leverage the positive sides of having a good co-founding relationship with our extended leadership team, in just being able to listen to different points of view. I think one of the great things that we have in our existing leadership team is just this ability to share and voice their opinions without really being judged or thinking that, hey, if I say something different from what X person is saying, then I'll be judged or people will not take it nicely. I think we've probably extended the chemistry between the two of us and tried to build a similar chemistry with our entire leadership team, which, I can see also. We have a weekly meeting every week where we meet our leadership team. And people very openly discuss things that they don't agree with, whether they are running that department or someone else is running a team. Over a period of time, I think that similar level of chemistry and comfort has gotten extended to the entire leadership team, which I think is, if I were to reflect back 4 or 5 years back, wasn't there.
Got it. So it does take somewhat of a conscious effort and a recognition that, look, this is something that we run the risk of and we need to compensate by being more welcoming and open towards the larger leadership team. That's very insightful and valuable. Let's just switch to another interesting topic, something that you've written about on your blog, we've spoken about before, and which seems to be the flavor of the day, unit economics, right? Does anybody know this word? A year back, nobody did, but perhaps more people do now. You guys have been talking about this for a while, and perhaps because you had to face it forcefully sooner than others. But today, we hear more and more VCs talk about unit economics. GMV seems to be some word in some dictionary edition that used to exist many years back. So what's happened? What's changed in your view?
Yeah, I think part of it has to do with the fact that even investors are now getting impatient. They're realizing that there is likely less correlation between GMV and building lasting, enduring value in a company. And there's probably more correlation between unit economics, which is the amount of money a company makes by deducting all their direct costs from the margin they make by selling a product or service. There's more correlation between the unit economics and the lasting, enduring value you're building. Because as Rohit had earlier said, the only definition of product market fit in our view is the ability to generate positive unit economics. In other words, even more simpler terms, if you're generating...
That's actually a very, very good definition. You said the definition of product market fit is your ability to generate
unit economics.
Unit economics. That's very interesting. Guys, one good lesson here. In addition to many.
Yeah, I think the even simpler way to explain that is positive unit economics means that the consumer is allowing you as a company and a service provider to make money while serving their needs. Negative unit economics means that you're having to pay the consumer to use your service, right? And so our view has been now for a few years, and again, we weren't born with this learning. We made a lot of errors along the way to finally get to this realization.
Yeah, and I wish we could say that we learned from other people's mistakes. Yeah. I think in this case, we probably went to the dark side ourselves in 2015, where we did spend a lot of money. And I think something at the end of that year, while our GMV had also grown, just something wasn't adding up to us. I think it was probably the Banya mindset, and both of us. He's more of a Banya, although I am the Banya. But yeah. I think the mindset in us was just something wasn't adding up. That the GMV was growing, but just somehow we were starting to feel more and more uncomfortable with our own business. That we just didn't see a light at the end of the tunnel. That when will this business make money? And that's why I think we started course correcting the business back in 2015. And since then, I think we've maintained our viewpoint, whether it is the flavor of the month or not the flavor of the month, we maintain
the flavor of Snapdeal.
For us, we maintain that point of view that the ability to generate unit economics, especially in a commerce business, is the paramount product market fit. And unless you're able to do that, essentially you are bribing consumers to buy your service versus truly adding value to what they are trying to do.
Yeah. That's, again, this is a very important area, so I'm going to dig in a little bit more. Just to provoke you guys a bit, was it really a very deliberate step back decision? You looked around and you said, I don't feel comfortable? Or was it more of your back against the wall and not maybe 2015, I guess you had access to enough capital, but was there some bit of that seeing the writing on the wall that maybe capital won't be available as much as it was? How did you come about?
I would say if there's one positive aspect of our culture is that there's a decent amount of intellectual honesty where we will make mistakes like everyone, but we are okay to look in the mirror after a certain period of making a mistake and say we are making a mistake. We did that, I remember in 2011, now many people here may not even remember, we didn't start as in like a product e-commerce platform. We started as Snapdeal started as selling coupons for restaurants and spas.
Like
and
the
so
Groupon, what was known famously as,
and
infamously as Groupon.
Yeah, well, now infamously. But in 2011, everyone was like, had only praises for us, for the company. That, oh, these guys are the Groupon of India, they have 75% market share, there were 50 other players, all of them have gone out, these guys executed really well. And while everyone around us was complimenting the progress the company had made, we were so nervous because we were realizing that this business will never become very large because India at that time didn't have enough restaurants, didn't have enough spas, salons, for us to build a large business to justify the large amount of capital at the valuations at which we had raised that capital. So we proactively did a very significant pivot in the business by shifting away from selling coupons to selling physical products, right? Similarly,
This was in 2012,
12. Yeah, 12. Similarly, I think in 2015, it wasn't really, we weren't told to do this by any investor, board member, or anyone externally. It was our own realization that eventually if you're selling stuff at negative unit economics, you're going to run into a wall. Because the bigger you grow at negative unit economics, your loss expands.
The more capital you'll need, external capital you'll
need. And that this will end in a very, very bad train wreck. So if we can course correct ourselves without being pushed into a course correction, that's always going to be better.
That's good. So do you think, now that everybody's talking about it, obviously you guys saw it much before and you've had the ability to course correct into a model that's working very well, and we'll talk about that as well. But do you think now that a lot of other entrepreneurs are seeing this, we've had the WeWork saga and we've had various different events unfold, is capital becoming less of a differentiator and the old game is over? And, is making money back in fashion and you think this is here to stay?
I think maybe not the direct answer to the question, but what we are seeing more and more is that entrepreneurs are willing to be far more patient with building their businesses. And part of the reason companies go onto this path of accelerating and burning money and growing rapidly, phases we've also gone through as a company, because there is an impatience entrepreneurs feel, maybe even some investors feel, to show progress. But lasting, enduring enterprises take time. And one of the things Rohit and I have done is we've been spending over the last few years a lot of time with businesses that you would put in the bucket of lasting, enduring companies, whether it's banks or retailers or FMCG companies.
Just old school companies who you've gone and learned from.
What we find very interesting and very inspiring is what we all in our world call old school companies. In the same decade of their existence, they've actually built a lot more value, some could argue, because they're profitable, they're growing really rapidly, they're public, they generate positive EBITDA, and they've built very successful and large brands. I think the fundamental difference between the two is just there is an inherent patience and long-term focus which you see in some of these companies, which I think our sector definitely we feel we can learn from. That if we have the patience and the patience to stay in the game for the long term, focus on the right fundamentals, and let time do its work over a period of time versus getting impatient to get to a certain destination within a year or within 2 years. I think that makes a lot of difference in our opinion.
Yeah, I mean, one could argue whether that has to do with wisdom, character, or just macro events. Many of these companies didn't have the capital-drenched environment that we've had to grow up in, at least in the last few years. So when you're competing with somebody who's announcing $1 billion raise every few months, it becomes very hard to use wisdom to somehow justify that you will not raise in that climate. So I think now that the climate's changed somewhat, one can perhaps take a slightly more patient approach. But could you have really taken that approach at some point in hindsight, if you think about it?
Probably not, right? And hence we did not, right? But that doesn't mean that we can't learn from it, right? And that doesn't mean others can't learn from it also. You're absolutely right. I think there was this window of time when a lot of money was coming in, and if you didn't raise the money that was being made available to you, you are not in the game. But that was then and this is now. It's important for us to learn from that phase.
Yeah, I think the great thing is that you guys are going strong. You're still very much in the game, and with all the wisdom and the battle scars, I think the road ahead is going to be very, very interesting. But capital, regardless of whether we know that madness that happened in the last few years is probably not going to continue, right? But whether there will still be a lot of capital available because a lot of VCs and PE guys have raised capital and people have recognized the opportunity. How do you see, for entrepreneurs here, right? How do you see, how should they think about raising capital? Should one person be focused on raising capital while the other person or the other co-founder builds the company? Or is there a different model to this?
I mean, that's what we kind of did. We sort of split that responsibility. And it's really a full-time job, at least in the early stages. But there's an interesting saying in the Gita which is very pertinent in the context of VC financing, which is, what you take owns you, what you give sets you free. And I think that absolutely applies to raising venture capital. I'll leave it at that. But I think
that's the reason you guys angel invest?
It sets us free.
One of the things that I think we've learned about raising capital is obviously raising capital is important in the early stages of a business because you want to have capital because you have certain ideas which you want to implement. Some things require money. You also know as an entrepreneur that many times plans that we've made may not go as per our original plan, and you want to have a certain amount of backup as capital, to make sure you're not running completely on the edge. And if one iteration of your plan fails, then you have no company. So I think for all those right reasons, it makes sense to raise capital. That said, I think when it gets dirty or when it starts having a negative impact on a company is when entrepreneurs start building businesses to raise capital. It has to be the other way around. And sometimes in the madness of raising capital, people tend to forget it's the same eat to live versus live to eat
you don't know which is the cart and which is the horse.
Are you raising money to build the business, or are you now building the business to raise money?
Yeah.
I think when it crosses to the other side is when the problem starts happening. And it's very important and as you rightly mentioned, that we, both me and Kunal, angel invest as well. And actually, for most of the entrepreneurs we work with, we actually even tell them, at least our opinion, is that if you don't need the money, even if you have the money, don't spend it. Don't feel compelled to spend money because you have it in your balance sheet. And I think that's very important to keep in mind that, raising money is important to make sure you are able to fulfill your plans. But having money should not be the reason why you start going in a certain direction in spite of, it not making business sense.
Yeah, I couldn't agree more. I think one of the things that we were talking about, and it's important point to make, is raising capital also has deep ramifications on culture. When your employees and when the whole company gets used to looking at news about you raising the next round, and that becomes their definition of success, and pretty soon not just raising capital, every time they see you in the news is when they feel you are achieving success. So new products, hiring more people, raising more capital, and that changes the entire fabric and the culture of the organization. In fact, we were saying that if you're doing so much out in the media every quarter, something's not working. It's not the opposite.
I think there's this, it's a very interesting point that you bring up, and I think we've seen that in our business as well. There's this very interesting documentary about Lego's turnaround. Lego is almost a bankrupt company back in 2003, and then it got turned around. And the CEO who turned it around had a very interesting saying, which I think all of us remember, and we make our team remember every time as well, that most companies die of indigestion with good ideas than of starvation with good ideas. Even a very, very successful and innovative company can do one, at best, 2 new things in a year or 2 versus doing 7 new things every year or 1 new thing every quarter.
That's a very counterintuitive, valuable lesson, huh? Because most people think more ideas, more success, right?
Not our experience.
It's not our experience, because we've seen that at any point of time, any management team, at least the ones that we've seen, can execute really well 1, 2, maximum 3 things. And it's important for a company's culture to have the ability to finish things before picking up new things. It's always very exciting to keep starting new things, but if you don't see anything to the end, it's not going to really add any value to the business overall. It'll sound very exciting because you started something new. For the first few months, there'll be a lot of, jazz around it, but then over a period of time, if you don't finish it, it's not going to build any meaningful value for the business. And hence, we internally also sort of have a rule that at any point of time, we are working on 2 or 3 important things. If we want to start something new, which is very, very exciting, we put a rule upon ourselves that we need to shelve one of these 3, 4 to pick the new thing, so that we are able to dedicate full attention to it and make sure we give it our best shot to make it work.
I think just one more point I want to make to that is a question you asked, which is how do you manage a team that may probably be looking at the headlines and determining whether the company is making progress or not, as compared to what the company is actually working on. And this was one of our big lessons around building a culture that is aligned to real goals, real actions, which is around over-communication. We spend an incredible amount of time. I think Rohit and I probably spend at least a third of our time just communicating internally, just again and again and again. Like literally folks have to get sick of, I'm sure our team is sick of hearing the same things from us over and over and over again about here are the top 3 goals of the company, here are the 3 strategic projects, here's what we are focused on, here's what we're not focused on. Creating many open forums, small groups, one-on-one, monthly town halls, to give our team the opportunity to ask us anything that's on their mind. Everything is fair game. This company announced this funding, how does that impact us? This regulation change, how does that impact us? And why are we not advertising on TV when other people are advertising on TV? What's our thinking there? Is it because we don't have money, or is it because we have some strategic view to that? So I think just creating enough forums to communicate and over-communicate is very critical to the point where now in our company, our team actually doesn't care what comes in the press about us or about someone else, because they have full transparency about what's going on, what's going well, and what's not going well.
So culture is built that way, I agree. It takes a lot of repetition, sometimes overstating the obvious as well. And it's great that you guys are following that as well. Let's talk about angel investing, something that is close to your hearts, both of you. Also invest together most of the time, or all of the time, I would
100%.
say. 100% of the time.
We don't have a single investment in which both of us are not
Wow,
invested.
great. So there's no conflict of interest at all there. But what is it that, are there 1 or 2 things that you look for in opportunities, and 1 or 2 red flags for all the entrepreneurs here?
Yeah, I would say there are 3 main things that we look for. Firstly, why do we do it? Our fate, our economics, everything is attached to our core business, the one we built, which is Snapdeal. But this is how, 1, we give back, but also vicariously enjoy entrepreneurship again and again and again. Because at one point in time, we can only build one company, but we can be a small part of many of these entrepreneurial journeys, some of which go on to impact, touch lives of millions of people each. And that is very, very invigorating for us. What we look for is really just 3 things. 1, the team. literally like looking into their eyes and seeing, can they actually build this? The second is just the size of the opportunity. Everything doesn't have to be a multi-billion-dollar business, but it has to justify our involvement, our capital. So it has to be a sizable outcome eventually in terms of its impact. And the third is, back to the boring topic of unit economics, the ability to generate economics, right? So, which means that we will also not invest in a bunch of things that don't meet some of these criteria. It may be a great team, it may be potentially a large opportunity, but we don't know how the economics will get generated. Even in that case, we'll continue to support the entrepreneur, but not as investors with capital, but with our network, with our learnings. But we find it incredibly exciting, incredibly interesting. It adds the intellectual diversity in our lives. It actually makes us better entrepreneurs also at our own business.
Yeah, I feel the same.
In addition, I think one of the other things, like what we don't do also, as Kunal mentioned, is we see ourselves unable to invest in sectors that are seeming hot, or this is the in thing these days, if some of these principles are not met. If we don't think a business, at least in our view, can generate positive unit economics, no matter how hot the sector may be, we just find ourselves unable to feel convinced that we would want to invest behind this. And I think the one thing which we were realizing we care about a lot, specifically with respect to the team, is we've now cumulatively met a lot of people, a lot of entrepreneurs, a lot of team members, etc. And there are certain people we meet who have the right answers to everything. You ask a question, they will have the absolute right answer. Which
They've been to every VC in town.
I think for us, that level of intellectual honesty becomes very important. That most human beings, even regardless of how smart they are, they don't know certain things and they don't have certain answers. They're still figuring certain things out. And I think that stands out. I think over a period of time, you train yourself enough to see that people who have sometimes seem to have the right answer to everything are probably people who are not being honest to yourself or not being honest to themselves. I think just to us, that is very important as well, being able to call a spade, that, hey, this is what I do, this is what I'm good at, we don't understand some of this, these are the problems in our business, no problem, we'll fix it. I think that level of, intellectual honesty and awareness is very, very important to us whenever we meet an entrepreneur.
So if any of you are looking to raise money from Rohit and Kunal, unit economics, and second thing, be smart but not too smart. Okay. But how much time do we have? Somebody came here to tell me that, but I chose to ignore her. What? Sorry. How much time do we have? 5 minutes? For Q&A or? Okay. So I'll tell you what, I have a list of questions and this could go on for hours, but because we have only
They may not want that.
Say that again?
They may not want.
Would you like this to go on for hours? I'm sorry, you're going to have to redo your program. But I want to turn it towards maybe some quick questions and just make it a little more fun as well. Like you said, you seem to have the answer for everything. So now maybe I should not give you any time to think about what to say. Now, let me ask you a bunch of rapid fire questions. Maybe, Rohit, I'll ask you a few first, and then nothing too provocative. And then I'll ask Kunal a few. So Rohit, let's start with you, okay? VC funding or self-funding?
Start with self-funding, then VC funding.
Okay. 1 billion of GMV or 10 million of profit?
10 million of profit.
Okay. Delhi, Bombay, or Bangalore?
It depends on the weather.
You can say, depends on the weather. Good one. Okay. IITs or Ivy Leagues?
Ivy Leagues.
Ivy Leagues, okay. He went to an Ivy League, he went to an IIT, just in case you guys didn't know.
So I think he's smarter than me, which is why Ivy Leagues.
Okay. That's your humility talking again. Hire for track record or hire for potential?
Potential.
All right, good. You did well. I don't have any prizes. All right, Kunal, your turn. Let's see how well you can do. Invest in large markets or stellar teams?
Stellar teams.
Okay. Angel investing, a big numbers game or focused thesis?
Big numbers game.
Top value creator in India, Murthy, Tata, Ambani, or anybody else you like?
I think it's...
You have to say Tata, don't you?
Huh?
You have to say Tata, don't you?
No. I think...
Mr. Tata is an investor in Snapdeal.
Yeah. But I don't want to be unkind to the rest. All of them put together.
Okay. Favorite tech leader, Tim Cook, Elon Musk, Satya Nadella, Sundar Pichai?
I would say Elon Musk.
Elon Musk. Okay. Number of unicorns.
Because you asked tech leader. If you ask business leader, maybe the answer may be different.
Good point. Great point. Number of unicorns in India 2025, 50 or 100?
Unicorn in terms of revenue or valuation?
Valuation.
Well, I hope that there are at least 25 unicorns by 2025 in terms of revenue.
Okay, good. Great answer. All right, last few questions. Say the first thing that comes to your mind, and either of you can. When I say the word talent.
Oh, we have to say
Yeah, whatever.
overrated.
Funding. Overrated?
Angel investing.
Okay. VCs. Okay. Competition.
Necessary.
Scale.
Large.
Exits.
Important.
Good. Success.
Happiness.
Patience.
Family.
All important.
Fitness.
Very important.
And finally, fun. What is fun?
I think that's probably the most important thing at the end of the day. I think if you're not enjoying doing what you're doing, then you'll feel bored very quickly.
Absolutely. So, having said that, let's go and have some fun now. Thank you guys for being here. I don't know if we have any time left for a couple of questions,
No,
but
I think
we're out.
time's up.
Okay. Thank you. You guys were great. Thank you so
Thank you.
much.
Thank you so much. I would request Mr. Akhil Handa, the head FinTech Partnerships and Mobile Banking, Bank of Baroda, to please step forward. Ladies and gentlemen, we won't be having a tea and coffee break because there's so much of action packed for you. You do not want to miss this. So stay put. And we shall begin our next session on digital nations powered by Tata Sons. And for this, I'd like to invite on stage Mr. Pradeep Udas, Office Managing Partner West, KPMG India.
Hello, Atul. Atul, we're starting next session. We're starting the session. Okay.